Imagine waking up, checking your phone, and seeing headlines screaming that the US market could crash nearly 40%. Not next year, not next month, but starting today. Investors panicking, portfolios bleeding red, retirement savings shrinking in hours, and analysts whispering about a code red signal quietly flashing behind closed Federal Reserve doors. The scary part is not just the possibility of a drop, it's the silence before it happens. Because historically, the biggest market shocks don't arrive with fireworks. They arrive when most people believe everything is still safe. If you follow financial markets or have money invested anywhere, what you're about to hear could change how you see today's economy. And before we go deeper, if you appreciate honest market breakdowns without hype or confusion, make sure you like this video and subscribe to Market Truth Archives. This channel is built for people who want clarity when the financial world gets noisy and uncertain. Staying informed matters more than ever during times like these. Over the last few weeks, unusual signals have been appearing across multiple sectors of the US economy. While official statements remain calm and measured, financial insiders are quietly paying attention to warning indicators that historically appear before major downturns. The phrase code red isn't an official Federal Reserve term, but analysts often use it to describe moments when several economic stress signals begin flashing at the same time. Right now, rising bond yields, tightening credit conditions, declining consumer confidence, and unusual institutional money movements are creating a rare and dangerous combination. This combination has happened only a handful of times in modern market history. Each time these signals aligned, the market experienced sudden and painful corrections. These downturns caught everyday investors completely off guard. The danger lies not in one signal alone, but in their simultaneous appearance. One of the biggest concerns comes from interest rates. Over the past few years, the Federal Reserve has aggressively raised rates to control inflation. Higher interest rates make borrowing expensive for businesses and consumers. When companies struggle to borrow money cheaply, expansion slows, hiring freezes begin, and profit margins shrink. At first, markets often ignore these early warnings because corporate earnings may still appear strong on paper. But eventually, higher debt costs start suffocating growth. This is where the domino effect begins. Companies reduce spending, layoffs increase, and consumer purchasing power weakens. Suddenly, the economic engine that was running smoothly starts losing momentum. Another major signal worrying investors is the bond market inversion. Historically, when short-term government bonds offer higher returns than long-term bonds, it suggests investors expect economic trouble ahead. This unusual pattern has predicted nearly every major recession in the last 50 years. Right now, that inversion has lasted longer than many previous cycles. This tells experienced investors that economic pressure may already be building beneath the surface. The stock market often continues rising during these periods, creating a false sense of security. When reality finally catches up, corrections tend to happen fast and brutally. Large institutional investors, sometimes called smart money, have also been quietly adjusting their strategies. While retail investors continue pouring money into popular technology stocks and growth sectors, many hedge funds and large financial firms have been increasing cash reserves. They are also shifting towards safer assets like treasury bonds and defensive industries. This silent repositioning doesn't create headlines, but historically, it has been one of the clearest warning signs. It often signals that experienced market players are preparing for turbulence. When big capital starts moving defensively, it usually means risk levels are rising faster than the public realizes. Consumer debt is another ticking time bomb, adding pressure to the system. Credit card balances in the United States have reached record highs. At the same time, savings rates have dropped sharply compared to pandemic years. Many households are now relying heavily on borrowed money just to maintain daily expenses. When consumers carry excessive debt, they become extremely sensitive to economic shifts. Even small increases in unemployment or interest rates can trigger widespread spending cuts. Since consumer spending drives nearly 70% of the US economy, any sudden drop in spending can quickly send shockwaves through the entire market. Corporate earnings reports have also started showing subtle but important cracks. While some major companies continue posting strong numbers, many have quietly lowered future growth forecasts. This cautious guidance often reveals more than current profits. Executives rarely admit direct fear, but adjusting expectations downward usually means they see slower demand approaching. Investors who ignore forward guidance often get caught off guard. Markets suddenly reprice stocks based on future growth instead of past performance. This shift can happen far faster than most people expect. The real fear surrounding a potential 39% market drop comes from how overvalued certain sectors have become. Years of cheap money and aggressive investment growth have inflated asset prices. Technology stocks, artificial intelligence companies, and high-growth startups have attracted massive inflows. In many cases, stock prices have grown much faster than actual profits. When valuations stretch too far from reality, even small economic stress can trigger large corrections. History has shown that market bubbles rarely deflate slowly. They usually burst quickly once investor confidence begins to crack. Another factor creating tension is global economic instability. The U.S. market does not operate in isolation. Economic slowdown in Europe, manufacturing uncertainty in Asia, and geopolitical tensions all add pressure to American companies. When global supply chains weaken or international demand drops, U.S. corporate revenue can fall rapidly. Investors react immediately by pulling money out of equities. There's also growing concern about liquidity tightening across financial institutions. Liquidity refers to how easily money moves through the system. When banks restrict lending, businesses struggle to operate smoothly. Several regional banking stresses have made financial institutions more defensive. If lending slows dramatically, business growth can freeze. Investment declines amplify market downturns faster than expected. This can turn manageable corrections into major sells. Despite all these warning signals, markets rarely collapse from a single cause. Major crashes usually occur when multiple risks collide at once. Rising debt, expensive borrowing, reduced consumer spending, corporate caution, and global uncertainty create a perfect storm. When investors suddenly recognize these connections, fear spreads rapidly. Market sell-offs accelerate as everyone tries to exit positions simultaneously. However, market history also teaches an important lesson. Every major crash has eventually created opportunities for disciplined investors. Panic selling often looks. In the worst losses, during the 2008 financial crisis, markets collapsed dramatically, but later recovered. During the pandemic crash of 2020, markets rebounded faster than many experts predicted. The biggest losses usually happen when investors sell emotionally instead of planning strategically. Preparation matters more than prediction. Right now, the most important question is not whether markets can drop. Markets always move in cycles. The real question is how prepared investors are for sudden volatility. Smart investors focus on diversification, risk management, and realistic expectations. Economic uncertainty is uncomfortable, but it is a natural part of long-term financial cycles. At Market Truth Archives, the goal is not to create fear. The goal is to help viewers understand patterns that headlines often oversimplify. Warning signs don't guarantee crashes, but ignoring them increases risk. The smartest market participants stay alert during strong bull runs. History shows confidence peaks just before volatility returns. As today unfolds, analysts and investors will continue watching key economic data. Federal Reserve decisions, inflation reports, employment numbers, and earnings will shape market direction. Whether markets fall sharply or stabilize temporarily, these signals are reminders of how quickly conditions can change. Markets move on confidence, and confidence can shift overnight. Unexpected news or data often triggers sudden reactions. Staying informed is essential during uncertain times. If this analysis gave you a new perspective, share your thoughts in the comments. Real discussions often reveal insights that numbers alone cannot. Let us know whether you expect a major correction or believe the economy will avoid another crash. Open dialogue helps everyone think more clearly. If you found this breakdown valuable, share it with friends or family who follow financial markets. Staying informed together matters in uncertain times. Don't forget to stay connected with Market Truth Archives for future updates. When financial reality shifts, understanding the truth behind the numbers becomes more important than ever.